All right, so here is a great example of a multi-step problem for chapter 6. All right, and so in this problem, we've got a company reporting pre-tax net income from operations, and then we've got taxable income. Oops, okay, so we've got pre-tax net income, and then we have taxable income, okay? And then we're given favorable book tax differences, okay? And temporary differences related to depreciation, and we're told why. And then we have an unfavorable difference as well, okay? And then we have a permanent difference, okay? And so now we're asked to compute several different things. So part A says we need to compute B line's current income tax expense. All right, so let's think about what goes into current income tax expense, okay? And so for part A, we're going to start with our pre-tax net income, all right? And then we're going to line up our temporary and permanent differences, right? And then that's going to take us to our taxable income. And then we're going to be able to figure out our current income tax expense because that's what it's asking for. All right, so let's get started. So our pre-tax net income is given to us. And that's $1 million, okay? And now let's look at our temporary differences first. So favorable temporary differences are $100,000. A favorable book tax difference of $200,000 was due to a $100,000 favorable temporary difference relating to depreciation. So there's our favorable temporary. So if it's a favorable difference, it's going to decrease our book income as we go down to taxable income. And now what about unfavorable temporary? Well, we're told that we have an unfavorable temporary difference, due to accrued vacation. So that's unfavorable temporary. And that is going to increase our taxable income relative to book. And now, what about permanent differences? We have a favorable permanent difference, and we need to find that. And our favorable permanent difference was $150,000 from a dividends received deduction. Okay, so again, since it's favorable, okay, and so that should give us the ability to calculate our taxable income, which in this case is $800,000, all right? And now we know that our statutory rate is 21%. And so multiply our taxable income by our 21%, and that is going to give us our current income tax expense, which is $168,000. And this is our answer to part A. All right, so part B then asks us to calculate our deferred income tax expense or benefit. All right, so I'm going to scroll up here and do part B. And so we need to find our deferred tax expense or benefit. So what do we know about this? Well, we know we're only looking at temporary differences. We are not looking at our permanent differences. So we have a favorable temporary difference of $100,000, and we have an unfavorable temporary difference of $50,000. So what does that give us? That gives us a net temporary difference of $50,000, but we have to pay attention, right? So because our favorable differences were larger than our unfavorable differences, now our net temporary difference is a net favorable temporary difference, okay? And what is our tax rate? Our tax rate is 21%. I'm going to scroll up a little bit more, okay? So what does this do? This gives us a deferred tax expense of $10,500. Now, why is this a deferred tax expense? Well, remember, if it's a net favorable difference now, that is because we are paying fewer taxes now, but that means in the future that's going to reverse, and so we're going to have a deferred tax expense, okay? So the answer for Part B, which asks us to compute their deferred income tax expense or benefit, is right here, and it's a $10,500 deferred tax expense. All right, so Part C asks us to calculate their effective tax rate. All right, so Part C. All right, so first of all, how do we find effective tax rate? Well, effective tax rate is equal to the total tax provision, okay? So that's going to be your current and your deferred tax expense. That's your total tax provision equals current and deferred. Oh my God. Income tax expense and benefit. Okay, so that's your total tax provision. And then that is over your pre-tax net income. So once you found out your current and your deferred portions, you've done the hard part of this. You just have to remember to put it all together, okay? So let's figure out our effective tax rate. So we know our total income tax provision, because that's parts A and B combined, right? So part A was $168,000. Part B is $10,500 over $1 million. And that is going to give you 17.85%. That is their effective tax rate, not their statutory tax rate, but their effective tax rate. Okay? And then finally, Part D is asking us to reconcile the effective rate with the statutory rate. All right, so you're going to reconcile the effective rate with the statutory rate, which essentially all that means is you need to look at what is the difference between their temporary situation and their permanent situation. Okay, so we're going to look at income tax expense if it were at 21%. Okay, so our starting point is this hypothetical situation. So their hypothetical income tax expense is 1 million times 21%, which is 210,000. Okay? Now, what is their tax benefit from the dividends received deduction? Because that's their permanent difference. Okay? And so their tax benefit received from that is, so their dividends received deduction was 150,000. All right, times 21%. And that is going to give us 31,500. Okay. And that should then, when we reconcile those, that is equal to, so this number, if you notice, is our income tax provision. And so this process right here is our reconciliation. So we're going to go from our hypothetical statutory rate of 21%, okay? And we're going to pull out all of your permanent tax differences, and then that's going to get you down to your income tax provision, all right? And so that's what that reconciliation looks like.